sick of talking about the Fed. They sucked all of the air out of the room again this week with their meeting. Now they announced a 50 basis point hike. This is the 7th rate hike in this year, which is just stunning. The Fed funds rate is now above the 2-year Treasury rate, and you would think they would start to slow down, but that's not the message we got.
Right, and it's interesting that a year ago they thought they'd raise the Fed funds rate by 100 basis points in 2022. So clearly they've been more aggressive than they anticipated. And one of the offshoots of that meeting on Wednesday was that they actually raised their target rate, or the rate they think Fed funds will go to 5.1%. So that would imply 2 more rate hikes.
At a quarter of a point.
Right. And the other thing in those minutes was we didn't get any dissensions. And I was sort of hoping perhaps we'd get some dissensions because that would suggest they're closer to pausing than perhaps people had thought.
But there was, in the survey, there were 17 of the 19 did say that they think rate hikes were higher, but not everyone was on the same page. So there might be a crack. We're going to have to wait. The next meeting is not until February, so a lot of information to come out. And in the meantime, this is what we do know. The manufacturing survey is under 50. That shows that we are in contractions. New orders, they're down. The housing sector, clearly that bubble has been pricked. We saw a retail sales report earlier this week.
Right. It was down 0.6 month on month, one of the worst results we've seen. Industrial production was also weak. The New York and Philly Feds were weaker than expected. So the economy is clearly slowing. We've discussed that any number of times. The real question, though, is while consensus thinking may be that we're going to have a recession, has that been discounted in prices?
Yeah, that's right. This is the most watched for recession that I can recall in our careers, Derek. It's been a long time, but we look at where the Fed's fund rate is now, 4.5%, and we have not seen that since 2006. So we have a whole new investing class, and in fact, professionals in this business that have not seen a rate this high.
No, they haven't. I was also looking at the credit markets this week, because you often get a good message from the health of the economy from that, and high yield credit is still trading at a reasonable level. The spreads aren't widening dramatically, so that suggests that the economy is still in good shape. And really, I think it all depends on psychology. Oftentimes there are feedback loops. People's the performance of their 401k affects their spending patterns, what they perceive the value of their home to be, and that's certainly something the Fed is targeting. The question is, at what point will inflationary pressures abate, and how far will the Fed have to go?
And this is my problem with it, Derek, is they're trying to reduce the spiral of higher wages, because that is a big part of inflation. And how are they going to do that? Well, they're going to have to raise the unemployment rate, and we're talking in the millions of jobs lost. And this is really a target from the Federal Reserve, which is just bizarre to me. And really, of course, the people that have been hurt the most by higher inflation, of course, are those who are can least afford it. And now, of course, there's going to be an unemployment rate that is going to go up as well. So we're going to have to see if this is a structural problem that they're trying to fix, Derek, with higher interest rates, and I'm not really sure about that.
I'm not either. I mean, I've heard differing opinions about what the job opening survey means, whether that number is overstated. It's certainly something the Fed has cited, whereas on LinkedIn, I've seen much lower numbers. So again, statistics are interesting, but you really have to look for longer-term trends in order to be a balanced investment.
And I think the final thing, Derek, is where we ended up on Friday, down a little bit more than 1% on the S&P 500, around the 3,800 range. And of course, there's a lot of people who have targets for the S&P 500 on the downside and on the upside, and we're a long ways away from the downside number.
Oh, absolutely. I mean, some people are thinking the S&P could drop as low as 3,200, and they get there by saying a $200 earnings estimate and a 16 multiple. I'm not so sure that multiple is appropriate given where interest rates are sitting. And we are certainly, December is historically a pretty strong month. And on the month, the S&P's dropped 5.5%, the NASDAQ 6.5%. And so I'm glad, tactically we did raise a little bit of cash during the rally in November, and we're looking to redeploy assets as long as the facts don't change materially between here and those lower levels.